Okay, testing, 1, 2, 3. A little bit early, but we'll see if anybody's out there. Is anybody out there? Oh, let's see. Aha. There we go. All right, that seems to be in place. That's all set. Everything seems ready. Just need people and we're ready to go. Oh, what's that? What interesting things you find when you look around on your desktop. What? Oh, nobody's here? Hello? Nobody's working. If you guys can hear this, use the question box and say hello. There we go. Let's see if we can get the audio going and we'll be ready to go. Let's see, not audio, video, whatever that word is. Whatever the word for the other thing is. All right, should be coming on any second. Let me know. Okay, great. So now let's get going. Welcome, welcome. All right, put that away, gotta put that away, and put that away. And here we are. Look how bad that looks. All right, so we are down, wow, 1.5% on the NASDAQ, 1.5% on the Russell, 0.65 on the S&P, and the Dow is flat, but the Dow is being held up by Johnson & Johnson and generally like safety stocks. So that's where we are at this exact moment in time. Where's oil? Oil is 80.60. Wow, oil bounced off the 80 line. Was not going to put up with going down no matter what everything says, although it was pretty much of a draw on the oil report. Let's see. That was, ooh, why is it so skinny? Or why is my screen so wide, I guess would be the question. Yeah, that's true. My screen is extremely wide. La 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 la. What are we looking for? Thought today would be a good day to do like just a general post about strategy and what we should be looking for in our trading and investment strategies. So where was that oil? Here, nope, that's not it. There we go. So the EIA report said there was a huge draw on oil, 3.7 million. It was worse last week, but still that's a lot. 4.1 draw in gasoline and a 3.6 draw in diesel. You cannot ask for a better report for the bulls, and their initial reaction was not that exciting. You know, and that's because, you know, OPEC announced a production cut, but the production cut doesn't take effect until next month, until May. So it doesn't change anything currently. And people immediately started trading off it like everything was going to be different already. I think the biggest change going forward, though, is the fact that Biden. Oh, I wonder if we can pull this up, because you know Biden used the Strategic Petroleum Reserve heavily last year, and the problem with using the Strategic Petroleum Reserve heavily. Let's see if we can get updated. March 31st. Is this the right week? When was Saturday? Yeah, I guess. Okay, yeah, it's got to be the current one. Okay, so inventories decreased 3.7, blah, blah. Yeah, it's the one we just read. Okay, so last year, Biden used up a lot of the Strategic Petroleum Reserve. It went from 564,000 million to 371 million. That's 200 million barrels of oil were released from the Strategic Petroleum Reserve over a year. So what does that mean? That means that, first of all, that it's got to get bought back. So at some point, an extra 2 million barrels for 100 days or whatever, or for a year or whatever, but basically 1 million barrels a day for another year has to be bought on top of our usual consumption. If they want to refill the Strategic Petroleum Reserve, they've got to find 200 extra million barrels of oil and put it in there. That is a huge demand. So despite the declining demand that we've had, there's now going to be a pull demand going the other way. So, you know, it's not like oil is going to be super bearish, because that's going to be supporting it for quite a long time. In reality, though, we've been using this oil to export to our allies in the war effort and so on and so forth. So, I mean, exports now are unbelievable. Every time we look at it, it's a bigger number, right? 4.3 million barrels per day we're exporting. So this oil coming out of the reserve wasn't being put in America. It was being sent overseas to people who needed oil from all this nonsense going on with Russia. The thing is, though, that rather than Russia putting oil back online and ending the war, instead Russia has now agreed with OPEC to cut back another 1 million+ barrels per day of oil production. So they're putting the squeeze on everybody. And frankly, I mean, I can't You know, I mean, I guess OPEC would argue they're an independent body that doesn't play politics, and therefore this was the smart thing for them to do, was to cut their production. But the reality is, with this Russian, with the war going on, Russian production, Russian output is already curtailed, and it's certainly not good for the world balance of oil. But of course, you know, it's not OPEC's job to keep oil cheap. It's OPEC's job to keep oil expensive. That's what they're there for. Now, of course, that's, to some extent, you could argue that having oil at a quote proper price would create stability in the market. But there's a whole bunch of ways you can look at these things. But you could, so no, you can make an argument any way you want. 4.362 times 7 days. It's so sick. 30 million barrels a week we're exporting. 30 million. Our daily consumption is 20 million, and that includes what we export. So it's a day and a half of our total US consumption, which again includes 30 million. So in other words, our real consumption is 20 minus 4.3. That's our actual consumption. The rest we're exporting. It's not US consumption if we're exporting it. Right? It's not, so we are not using more oil. We are exporting more oil. We are taking it into our refineries and changing it into something else and then selling it overseas, outside of this country, to the tune of 30 million barrels a week. That's really insane. It's a war. I understand why they're doing it and so on and so forth. But the reality is we've been doing it before the war. The war started last year and we were already exporting 3.8 million barrels. Now it's just gone to a complete extreme. It's just insane. So, you know, and you'll see these reports of US consumption and they say, oh, US consumption is this. And it's like, no, it's not. That's bullshit. We don't consume that much oil. We export what's 30 out of let's see, so it's 140. So it's 30 out of 140. Oh, same calculator. So 140 million barrels a week. So 21% of the oil that we supposedly use is actually exported. And that's where that is. So there's no actual shortage of oil, except for the fact that we are committed, I guess, to probably sending that out of the country. But there's nothing like a shortage of oil in the US. In fact, that's the other thing. Look, we used to import 3 million barrels a day, and now we're importing 1.2 million barrels a day. So we're importing, I mean, that's 1.7 million barrels every week. We're importing less. So we're releasing our strategic petroleum reserve, importing far less oil than we used to, and sending oil out of the country. It's a completely artificial shortage. That's why even this crazy pumped up report isn't even enough to satisfy the expectations of the plus 80 oil. It's very hard to get to that level because the reality of demand and supply situation is not where this would be. You know, and that's obviously with the war premium and everything else baked in. Let's see. Okay, so that's enough about that. We don't have a long time because I got a family dinner, early family dinner for Passover today. So happy Passover and happy Easter and whatever else you may want to celebrate. Enjoy yourselves. Have a nice long weekend. It's all good. Let's see. All right. So what else is going on in the world? Here's my Wall Street Journal. There's my Wall Street Journal. What does a Wall Street Journal think is going on? They're still upset about their journalists being taken. Let's see. this Trump thing, those still going on. Blinken, Democrats, FedEx, who cares? It's nothing. Very boring day. Boring news day. I think everybody's getting ready for the holiday. All right, so Trump's been indicted. That's all over. We're past that. Now we're going to have, God knows how long this will drag on. I mean, if you're indicted, what is that? It's got to be months. It's going to be, it'll be summertime by the time they get to an actual trial. I imagine they got to pick, you got to pick a jury, right? Then you got to give the lawyers time to prepare. You got to pick a jury. Then you have to set a trial date. And then they're going to add, there's going to be delays probably for whatever reasons. And then finally you'll get to have a case at some point. And it seems like to me that would be, if this is April, we'd be looking at summertime. Like probably I'd say August would be the most likely. So this will be kind of bored. We'll be bored with it by then. Certainly not market moving. I mean, it wasn't like anybody didn't expect it. Chipotle peppered with complaints. Oh, I think they just like, if they can figure out a way to make a fun headline, I think that's their whole goal. Look at the overuse of animation these days. Oh, because they're using ghost peppers? Is that what they're doing? I don't know what's wrong with these people. I don't eat Chipotle really. I don't know, but I mean, I think the sauces are way too wimpy generally. Anyway, so that's the most important thing going on in the Wall Street Journal is Chipotle is making their sauce spicier, which I'm all in favor of. So not a big deal for me. All right, what else is going on? Let's take a look at, like I said, let's take a brief rundown of where we were today. So I was talking about the 10 commandments of market investing, since it's Passover. And what are we talking about? We're talking about investing regularly, be consistent, diversify, of course, have a plan, which we talk about all the time, being patient, which I'd say being patient is probably the single hardest thing I try to teach people. It's you know, one of the main reasons I wanted to set up a trading community like this was for myself, frankly. It was it's boring. If you trading properly is boring. Most of the time you do nothing. Vast majority of the time you do nothing. So it's good to have other people to talk to and exchange ideas and talk about the market and so on and so forth. Because if you're going to sit there and constantly think about trading, you tend to push the button too much. It's good to have a community to chat in. It's much better that way. You know, people trying to time the markets. And yes, we time the market, but our timing is more based on fundamentals. It's not so much timing as it is that we believe there's a certain value to the indexes. We believe there's a value to the stocks. And when we go below that value, we buy, and when we go above, we sell. That is not timing per se. Because, you know, we don't care what time it is, we care what price it is. We care what the value of something is compared to its price. That's what drives our decisions. So people think we're really good at timing things, but we're not. We're just following our own primary rule of value. Be the house, not the gambler. You've heard that a million times from me. Don't chase trends. You guys know how I hate that. It's don't let emotions drive your investing decisions, obviously. I mean, and again, it's, you know, this is what happens when you're not prepared, right? When the market dips suddenly and you don't have hedges, it's upsetting and people tend to overreact. And when the market goes up suddenly and you have too many hedges, people tend to overreact, which is why we kind of strive to have a balance overall. That's what we're really looking for. We want to have a balance to our trading. We want to have a balance to our portfolios so that nothing is going to make them suddenly veer one way or another, you know, off the road. And then finding value, that's basically what it's all about is, you know, if you're going to buy something when it's on sale. And I mean, these were, I was looking for like the most basic concepts that we had to like stress for people. And regularly review and rebalance your portfolio, which is why once a month on options expiration week, we like to do it just because that's the time we're most likely going to make changes. But once a month on options expiration date, we review all of our positions in all of our portfolios. And again, it's a little bit tedious. We do it over and over again. And most of the time we end up doing nothing, but that's when we do make our changes. But you've got to always be looking at your positions. And, you know, when we do these reviews, where's a review? Oh, review. What are you? Oh, you're the watch list. We're not going to change you. So when we do a portfolio review, was this going to be a good example? We just did the $700 portfolio review yesterday. So, you know, when we do a portfolio review, we say, well, what are we trying to do here? So here we sold 2 CIM puts and we expect to make $280 in 20 months, right? That means we're going to make $10 a month on this position. So what are we doing with this position? It's $500 worth of margin, and we're going to make $10 per month. All right, that works out to 56%. So basically, we're going to make 2.5% per month. We're going to make 2.5% a month on this position. 2.5% a month is great money. It is boring, but it's great money. We're not worried about CIM. We don't think it's going to go lower. And if it does go lower, we're happy to buy more of it. So there's nothing about this position I don't like. And we sold 2 $5 puts for $320. So that's for 160 each. That's net $340 is our position. So really, because we made some money, that's the current margin. You know, there's $1,000 of margin and there's $280 of cash in this position. So we're only using 600 and blah blah blah, $620 of no, I'm sorry, 720. We're using $720 worth of margin. The more we gain here, the more margin we're using because we have less being protected by it. You know, we have less cash against the margin, but on the whole, when we set up the position, it was 1,000 minus 320, which is $680 in total margin in the position. So I don't know why I said we're using 500 in margin. We're using more. We're using 6 something in margin. So we're going to make, no, I'm not sure where I got that number from. Anyway, so that's the fact of it is it's $1,000 in margin, right? Less the cash that we put in was 320. Because if we closed it, we'd have to take the cash out, right? So it's not free. It won't get us back $1,000 in margin because we'll have to use $280 worth of cash to close it. So the balance remains about the same. But we started with $680 in margin. We're going to make $280. And the point is, though, we have $280 left to gain over 20 months. So every month we're going to gain $1.40, basically. That's the correct way to look at it. So we're going to gain $1.40 a month. But still, it's not bad interest. $1.40 or 14? $14, sorry, $14. It makes it sound better. So the real number, because I was incorrect, so the real number is 14 into our margin, which is 14 divided by 680. It's it's exactly, it's the same 2% a month after all that. So anyway, so 2% a month. All right, so is there a reason to kill this? No, we're making 2% a month, that's 24% a year, that's fine. That's as much as we need to make total. We make 20%. If we make 20% on everything we have, we're going to be in great shape. Now, AT&T, we looked at AT&T, and here's a good example of why you review, right? Because we looked at AT&T and we said, well, AT&T is paying a 5.7% dividend. But the way we structured this, when we first took it, we were very conservative. We bought the stock for $17.93 and we sold the $17 calls, right? So at the time, that made perfect sense because we sold the $17 calls for $3.40. But now we've made $100 and something, and we're getting this dividend, but the margin is a little bit too much. It's a $1,700 in margin. So I'm looking at that and saying, you know, we're not really going to collect enough money. So we're going to only make $116 plus 9 dividend payments is $250. So we expect to make 23.1% total against our margin for the next 2 years. So in this case, it's not a negative. I can, in this case, we can cash it out for $1,600. So it doesn't make sense to hold this for 23% over 2 years. This is 20% over 2 years. I'm sorry, 20% per year. This is 20% per year, 24% per year. This is 23% over 2 years. It just doesn't make sense. So that's, again, this is what we're doing. We're reevaluating the value of the position. What is this position going to do for us? How much is it going to make for us? Just like any investment, right? I don't care if it's a house or a piece of jewelry or your Bitcoin or your comic books. It doesn't matter what it is. You got to look at every single thing you have and say, what is it doing for me? What is it going to do for me? What are my expectations over the next 10 years? If you buy a comic book for $3,000 because it's like, you know, Spider-Man number 1 or something like that. So you buy a comic book for $3,000 and you say, well, I expect it to be worth $5,000 in 10 years because the market is good. Next year, if you look in the catalog and you see that your comic is only worth $2,900, it's not on track. It's not doing what you thought it would do. And so you have to consider taking the loss. Take the $100 loss, put your $3,000 to better use. And again, obviously, if you like it and you want to put it on your wall or something like that, then it has other value to you, like an art piece, fine. But, you know, don't kid yourself that things are investments when they're not. All right, I got 2 children. I got one who's going to be an artist, and I got one who's going to be a management, you know, in computer science management. So Jackie, my little one, is going to be a good investment. She's going to pay off. Maddie, maybe not. You got to reevaluate your investments. So for 20 years, I've been staring at these things going up and down, trying to figure out which one to keep. No, I love my kids, but I'm just saying, I mean, everything you gotta look at something and say, is this going to pay off me? Is this a good investment? You know, I mean, in seriousness, because Maddie's backup career, she wants to be a therapist for her backup, so she's taking psychology and so on and so forth. But we just had this discussion because she wants to go do 2 years of grad school, which is going to cost me $150,000. And you know, I'm like, you know, it's going to cost me this money. This is her fallback. She doesn't even want to really do it, but she hopes to be an artist. But if she doesn't get jobs in art, if she has to make a living doing this or something like that, then it doesn't make sense for her not to get licensed. And we talked about whether she should get it right away or whether she should, you know, hopefully get a job, you know, with her regular graduate degree, get a job in something that will pay for her to get her master's, which would save a lot of money. And I'm saying to her, I'm like, this isn't nothing. This is a large commitment you're going to make to a job you don't absolutely want. It's not your number 1 thing that you want to do. It's your number 2 thing. So your backup plan is becoming very expensive. You know, and you got to teach your kids and you got to teach yourself to look at things this way and think about the pros and cons and whether or not you're getting the value that you're expecting to get. But you know, for stocks that you have, I mean, if you're trading stocks, don't be attached to them. You got to go through every one every time and say, you know, it's you know, for the stock, it's not like my daughter. I'm not like, what, you know, what's going to make you happy? What do you think is going to really make, you know, lets you relax in life to say, okay, I always have a way to make money. That's important for her. That's a lifetime decision that she's making right now. But for your stocks, it's like, are you making me money or you're not making me money? End of story. Here's SunPower. And in SunPower, we're saying we have $7,900 of upside potential. Okay, so what's the spread on SunPower is, where is it? Oh, restart and install, not now. So we have the 15-23 spread, and I want to roll my 15s to the 10s. So now we're going to have a 10-23 spread. SunPower is basically at 13, having a bad day, in fact. So SunPower is basically at 13. So is 23 a reasonable target? And I'm saying not, by the way. I'm saying let's say we get to $20. I'm pretty sure I said that somewhere. Oh, so I said let's conservatively expect SunPower to get back to 20, and that would put us $10,000 in the money. So can we get back to 20? And actually, if you look at a bigger picture, because that's a short picture on SunPower, well, that's not going to show it to me. Let's take a look at the longer term. So if we look at the longer picture of SunPower, 20 doesn't seem like that high of a bar. Hopefully this will be the bottom. This has been the bottom. Basically, this has been a pretty reliable hold down around 1250. And then we'll see what happens. But so I do think 20, see the 200-day moving average is 20. And over here, that's also basically the 200-day moving average. Here's the 40-week moving average. And we will see how that goes. But I think 20 in 2 years is a pretty realistic target for them. And if we hit that, we're going to make some very nice money. We're going to make $8,000. And don't forget, this is right now only a $5,200 portfolio. So that's basically the whole thing right there. But it has to be on track. And so having the 15-23 call, bull call spread, that starts us up here, and we don't make money until 23. We make a lot less money. So the amount of money we just spent, which was $1,000 net to roll it down, it puts us in a position to make another $5,000. So we've turned it into this spread. It wasn't before, and now it's starting to be a lot more attractive. We're taking advantage of the low price, and hopefully this will form a nice base. And we're going to have to watch earnings very carefully on that. And then SoFi, we have a $1,500 upside on that one. If we can hit 7, well, we're at 566. We almost hit 7 a couple of weeks ago. I think we're going to be in good shape on this one. That was days ago, it was last week, in fact. So I think we're going to be in good shape on this one. They didn't even get killed in the banking crisis. So, it's not just me that has faith in this one. But you see what we're doing here? It's like we know every penny that we anticipate getting from every position in the portfolio. That's what I mean by reviewing positions and looking at them. You got to have, this encompasses the plan and the patience and the review process of these portfolios. And of course, as I said, we bought them because we consider them good value stocks. Now, I named a lot of stocks here also. We talked about our watch list and what we're, and again, patience. But all these are eligible from the watch list. They're all low enough in price. And it's not about price, but in this, when you have to fit something into a portfolio, it is about price. And so all of these positions are of the price area where they may qualify for this portfolio. We can't afford a lot because we don't, even if we skip a week, we only have $1,500 to play with generally. Or if we cash something out, we don't have that much to play with at this early stage in the portfolio. As it builds up over time, we will also be changing the kind of positions we take over time. But the bottom line is we can't afford to just grab anything we feel like. So we're watching these stocks and in the top trades. And I said, well, you know what? We are obviously, when we're doing our top trades, we're already looking at all these stocks. So in the top trades, NYCB, SunPower, which we already have, BBAR, and UNG were all ones I was considering for this portfolio as well. So BBAR, nice and cheap, a cheap stock, and I like it. It's a bank in, but it's a Brazil bank, so a little bit worried about what's going on down there. NYCB, I like them because, and I talk about it down here, I like them because they just picked up assets from Signature Bank very cheaply, and I don't see how that's going to be damaging to them. The Fed would not have let them pick up the assets if they themselves had a shaky background. Okay, you might think everybody's an idiot, but they're not that stupid. I mean, it's like they didn't turn over Signature Banks to NYC. They didn't turn over Signature Bank assets to NYCB so NYCB could go bust. That would make no sense. So that's not likely to happen. And then UNG, we all talked about how we think UNG is basically, this is the dead bottom for them down here. And I talked about, first we talked about this, we had discussed this when we did the top trade about how much, see these operating, we'll pay attention to North America, right? How many operating LNG terminals do we have? Not that many. How many are planned? That many. How many are under construction? That many. We have this many, and we're gonna have this many shortly because they're already being built. These aren't notional. This is how much is actually being, has already been funded and starting construction. Based on that, I said I'm comfortable with these things. The upside potential on the NYCB is $510, and it's only a $600 spread that we're spending $90 in cash on. And so that's fine for us as far as the return. And then UNG, again, also it's got $600 upside potential. We're not like swinging for the fences here. And why not? Because we already have really good positions. We're already going to make it. We're already going to make what was the number? So we have $9,000 worth of upside potential against what is currently a $5,000 portfolio. So we're going to make 200% on the positions we currently have. We'll be adding to those over 2 years. We're going to put in another $15,000. But these positions now is what we care about. The positions we have now are good for a 200% increase basically from where they are now. So I do not need to add aggressive positions If sun power pays off, we have no problem in this entire portfolio. If it doesn't pull off, I want to make damn sure the other positions do pay off. So we are pretty conservative with our other positions. We have an anchor position and we have some conservative positions we're adding on to them. But this is in a nutshell everything we're talking about here. Nope, not here. Where were we? All right, we're investing regularly. Every month we put in $700 more into the portfolio. That's our plan. Every month for 30 years, we're going to put in $700 a month. So it's 700 times 360 is $252,000. And then if we go to a so if we go to a compound rate calculator, and I like the one that's from MoneyChimp because it's nice and easy. So if we start off with $700 and every year we put in $8,400 and we give it 30 years to grow at 10%, we're going to have $1.5 million. And our total investment is $252,000. So it's better than you're making 300%, but it's a lot better than 300% because you're not really putting up the 252,000 right now, right? In fact, look at this. If you did put up the 252,000 right now and added nothing and did the same 30 years at 10%, you have $4.4 million. So that's the difference between doing it gradually and doing it slowly. But again, if you're young or if you're poor, one of the two, if you can only afford to add $700 a month, but do that at least, right? But if you're young and you do it and you discipline yourself and starting in your first job, you say, okay, I'm going to take 700. If I make 5,000 a week, a month, so I make 5,000 a month and I'm taking home $35,000. I'm going to take 20% of that money and take that's where I came up with it. So I'm making $5,000 a month, $60,000 a year. I'm going to take home 35, probably more, probably $40,000. I'm going to take $7,000 of that money and I'm going to invest it. Every single month, I'm going to take $700. I'm not going to go to a fancy dinner. I'm not going to buy an expensive bottle of wine. When I pick a house, I'm going to pick a house that's a little bit cheaper so I can keep saving money. You've got to have that discipline that this is money you never, ever touch. And the sooner you start doing it, the better. Because watch this. Look, it's 700, right? Look, 700. You're going to add $8,400 a year. 30 years, 10%, 1.5 million, right? But what if you do it for 40 years? What if you're a little bit younger? Then it's $4.1 million. Now, obviously, if you get richer, if you make more money, if you get older, and you can increase that number to 1,000 a month, 1,200 a month, you're going to, massively increase your amount of money for retirement. And you're doing this yourself in your own account. So that's the difference. Like a little tiny thing like that makes. But what makes an even bigger difference is, again, we're on track right now to make 12%. 12% comes out to $2.2 million versus 10% is 1.5. 50% more money if we get to 12%. If we are doing 20% on a steady, normal 20%, that's going to put $12 million into our. That's the difference between 10% and 20% is 10 times. That's how much difference it makes whether you make 10 or 20%. So stop trying to make 50% because it's too hard. It's unrealistic, but there's nothing unrealistic about making, 16%. Warren Buffett did that. If Warren Buffett did it, we can certainly do it. He averages about 16%. That'll bring you to $5 million in 30 years with $700 a month. If you're 30 years from retiring, and I don't want to say 30 years from retiring, because if you're 45 now and you're going to retire at 65, there's no reason not to start this track, because when you're 75, this money kicks in. If you just start doing it, it's like not doing it is terrible. If you start with a higher principal, by the way, oh, here's another thing. So let's go back to, so let's say we're just doing about 12, let's say we're just doing 12%. You're on path to make $2,291 for $700 a month, right? But let's say you start with 7,000 instead of 700. That's the only change. That's going to bring you up to 2.4 million. So going from 700, 2.2, oh, is that only 7,000? Oh, I thought it would have been bigger. So much for that. That's interesting. How about 20? No, not a lot. So at 12, it's not going to make a lot of money, but at 20, it's going to make insane differences. At 20, 16.6, and let's go back to 7. 12.9, $4 million. So in other words, if you could come up with $20,000 now, right? Instead of $700 now as your first payment, if you start off with $20,000, let me make sure it's the right amount. Yep, 20. Start out with 20,000 instead of 700. You're going to go to 16.6. So that $20,000 is going to make you $4 million extra. So think of that next time you're deciding on whether you're going to get this house or that house. What a difference in, it's $4 million. Let's make that really simple, right? It's $4 million. You're deciding whether to buy a $300,000 house or a $350,000 house. But if you took $20,000 of the $50,000 less you spend, not only will you have a lower mortgage payment now, but the money you put aside for 30 years will be able to buy you a mansion in 30 years. 10 times what your house is total by just shaving $20,000 off the price of the house and putting it into something that's making you, if you're making 20% interest. Let's do $12 million. So if you're making 12% interest, I don't want to keep changing the numbers, but if you're making 12% interest, it's a $600,000 difference. So 12%, very realistic. $600,000 is twice as much as you're spending on the house to take 20% of that $300,000 you were thinking about spending, to take 20% of it and put it in the bank instead. You can buy 2 houses at the end of 30 years. By the time you paid off this house, you could have bought 2. That's why, real estate is not the investment you think it is. You are far, far better off taking $350,000. So in other words, you take $350,000 and instead of, and you have $700 a month left, but if you're 350, well, this will get complicated, but if it's $350,000 and you can make 12%, right? You're gonna have $12 million in 30 years. But you won't, because let's say, oh, let's take away the annual, I can't take the annual addition. I'm trying to think of how to make this make sense. $350,000 is going to throw off $35,000 in interest. Well, there is a good way to look at it. Okay, so $350,000 will throw off $3,500 a year in interest, $35,000 a year in interest or more. That could be your rent on an apartment. Instead of buying a house, you could take that money and pay a rent and use the money that you're making off that money instead of tying up all your cash and making mortgage payments constantly. You can just pay the rent and then accumulate the money from the savings of not having to own a house which is frankly expensive owning a house and taxes and all that. Especially, oh, and especially look at your taxes. When you're buying a house, you got to really think about how much tax you're paying and how much they can go up. It's something people don't do. But that's the thing. It'd be a good thing to have a service like this, because you need to analyze, and nobody does this for you. You need to analyze the neighborhood you're moving into and look at the fiscal health of the community you're moving into to figure out whether or not they are likely to raise your taxes. All right, because when I bought my house in Jersey, I bought it for $400,000 in 1998, and the house never really went up much in value, like 650, something like that, over quite a long, over 20 something years. It went up to 650. But it should have gone much higher. But the problem is the taxes, which started off at roughly $3,000, were $22,000 a year by the time I was ready to sell my house. So in other words, the government was charging $2,000 a month in tax on my house, not to mention all the repairs and crap that had to go into the house anyway. But the government was charging $2,000 a month. So they were, and so $2,000 a month. So they wanted, let's say 0. They wanted annual addition 20. Well, so it was 22,000. So $22,000. Okay, over 30 years at let's say even 6%. So the forward value that they took out of my house was $1.8 million. Or actually, let's call it the increase from 3,000. So 19,000, $1.6 million. So that's what the government stole from me, because my investment wasn't able to grow because the tax for owning my investment became so high that it was more of a factor than the value of the home. And this happens to everyone to some extent. It's hopefully not so drastically, but it's insane. My stupid small town in New Jersey, and that's, that's why I left also, because it was not getting better. It was getting worse every single year. They wanted more and more money. And so it's nice to have a small town, but my nice small town with very, very little commercial property on it was just bleeding the crap out of all the residents. And what are you going to do? How are you going to fix it? It was, I mean, obviously it's a bloated government structure. They have runaway costs. The salaries have gone up. The school salaries have gone up. The government had cut back on their education subsidies, which caused us to charge more, and so on and so forth. There's a million reasons for it, but it doesn't matter. What matters is that the government stole my appreciation. They stole the appreciation of the home. It should have been a $2 million home, and instead I was lucky to get $650 for it. Because even the people who are paying $650 were like, Jesus Christ, the taxes are more than the mortgage. It is bonkers. So where were we? Oh yeah. So where were we? Invest regularly. Diversify. Now you notice that's another, well, it's hard in a small portfolio, but we diversify. We don't pick everything in one sector. We don't have too much stuff in one place. The investment plan, you can see, the patience, you can see, we add things just one bit at a time and build it up. We're not timing the market. We're just buying whatever is cheap at this time. We go to the store every Friday and we see what's on sale, right? Just like grandma used to do. We don't have, our biggest plan is to walk up and down the aisles and look for what's on sale. And then based on that, we're going to figure out how to make dinner. Being the house, not the gambler, we aren't at that stage yet because it's hard for us to build up the options to start selling, and we don't have the margin for it, but we will eventually. That's the thing. We're too poor to make money. At this moment, we're not rich enough to play the big game, but we will at some point switch strategies, and it's going to become easier and easier for us to make 20% a year. But that's down the road. But the point is now, what's the most important thing? Don't lose money. As long as you don't lose money, we're going to be in good shape. And obviously, we're not chasing any trends. We're not getting emotional about it. The stock has gone up. The portfolio has gone up and down with the market. What can you do? And we're looking for our value stocks regularly, going through our watch list and so on and so forth, and we review and rebalance. So there it is, in a nutshell. That's how it works. Those are the principles behind it. What did I want to look at? Something. Don't have too long. Let's see if you have any questions here. No questions. Oh, somebody said they don't hear audio. Oh, that's not good. Is the audio working now? Uh-oh. Testing. Seems to be working. I don't know. I hope this is working. I wish it would show me if it's recording. Oh, SK says yes. Okay, thank you. All right, good. So where was I? I was going to go on to something else, and then I said I wanted to finish this first. I mean, oh, I know the watch list. That's right. There you go. So here's the watch list in nice alphabetical order, although I'm not sure what the real purpose of it is. But what I like about the watch list is it refreshes itself. These are weekly charts. So it's really easy to glance over. Now again, we have to be careful in the small portfolio as to whether or not we can afford the stock, because we can't buy a $77 stock in that portfolio. But oh, I'm sorry. And for those of you, we can't buy it because we have to have 100 shares to trade options, which is our goal down the road. And if we can't buy 100 shares, what's the point? So here, 100 shares would be more than our entire portfolio's value right now. It's just not going to happen. We'd be too imbalanced to that stock. And yes, of course, we could buy a spread on ACAM. And the spread itself could be a $1,000 spread that's going to make $2,000. But we don't ultimately want to own it. We don't want to be stuck with it. So if it's not a realistic stock to fit in our portfolio, then what are we messing around with the options for? A lot of people make that mistake with options. It's just because you can, leverage yourself into a position doesn't mean you should. And that's a tough thing to get your head around. ACAM is excellent though, and we liked it. 83.50. I put the prices for the most part, if I remembered. So we originally liked it at 83.50. It was mostly around November that we were looking at things as I was preparing. The watch list is something we started putting together when we were trying to decide what was going to be the stock of the year. So it was back in November we started with this thing. Oh, I'm sorry, this is 12/28, but when I drew it up, I'm sorry, we assembled it, but it was on 12/28 that we actually wrote the post. So as of 12/28, those were the prices. But these were stocks I've been adding to as we were deciding what we would do for trade of the year. So we've gone through hundreds and hundreds and hundreds of different stocks and decided these were our favorites. So what's a good buy? Well, if it's cheaper than we bought it, we say, okay, so then you take the stocks that are cheaper than we bought it, than we wanted it for, and it went lower. So we're like, great, it's on sale. And then the question is, what changed? What caused this? Why did that happen? After we decided we liked it, it was going okay, but then it completely collapsed. Obviously, this was earnings were disappointing. And then we wanted to say, well, how disappointing were they? What's the real outlook? Does this bad quarter change everything? Or does this bad quarter just mean it's going to take them longer to catch up? So most likely it was a good buying opportunity when it crashed, and that's fine with us. We knew people were going to, that's kind of the whole point, right? That's the whole reason we do the earnings portfolio. Earnings portfolio is for people who have bad earnings when we think they're not that bad. We look at ones who have bad earnings and say, oh, are these really bad? Allstate's another great one, right? They were at 136, they crashed down to 105. That's a hell of a discount. And I think we added these to the long-term portfolio. And as I said, and these are weeks, don't forget. So as I said, insurance companies shouldn't be lumped with banks. It's not the same thing at all. Even if they have bought themselves a whole lot of low interest notes, they don't have any pressure to cash them out. Nobody's asking them to cash it out. It's just what they do with the money that you give them for the insurance. They put it into sound investments, and and it makes enough money. But they knew from the day they put the money in that the interest was going to cover their operations to allow them to run their business. Barring anything crazy happening like nuclear war or something like that. They don't anticipate having cash flow issues. So therefore, they don't need to cash these notes out early. And even if they do, well, if they do cash them out early, yeah, they may end up getting a discount, but they have no reason to do that. It's not the way they run their businesses. Insurance companies have been through all this crap many, many times. ADP, I don't really see jobs growing that much because we're 10 million people short now. So where is the job growth going to really come from when we can't find 10 million people? All we'll do is have 12 million openings and 14 million openings. We're not making more people unless we change our immigration policies, or unless people run around having a lot of babies, which they're trying to do with the by banning abortion. But that's a long-term solution. That's not going to help the workforce in the near term, is it? In fact, then they'll complain there's too many children, and they'll start cutting, and they don't want to pay for the education. So he's never going to win. Is Apollo in better times? I would like them, but here now, see, Apollo, I'd be a little nervous about the environment. Broadcom, we know is kick-ass, but that's not cheap. Boeing, not cheap. BC Barclays, yes, I think we picked them. Big Lots, I like them, but they never get it in gear. It was 15. So when we were looking at this, it was 15. Now it's 11. They just cannot get it in gear. I don't understand it. I like them, but they can't do it. Booking, again, travel being very good. Comeback, BlackRock or Blackstone or whoever, whichever one that is, says BlackRock. Also a reasonable price. They were 703. Now they're 652. And again, you don't know who's hurt by the financial crisis. It's not them, but then they have their money invested in a bank and the bank goes bust. You don't know where their investments are. It's too difficult to unwind. BGFV is cheap. They were 9. Now they're 750. I like these guys. It's a cute little investment. BNTX was 160, is now 126. They had a drastic sell-off. So we'd have to look at them very closely to make sure we want them. But this is what you got to do. You got to go through. I'm not going to go through every one. But BXMT was 22.25, and now it's 17.62. So we say, what happened? How bad could these earnings have been? Was their business really destroyed? This is the Blackstone Mortgage Trust. And I think they're definitely better than what they're showing. I think this is a crazy low price, but it's not, I think that, but I don't think it's so much that I've picked it up. Citigroup took a hard hit, but they were only 44.40 when we were looking at them, and they're not cheaper. Now, you could say they're holding up well, considering the crisis. That's one way to look at it. And this is probably a very good bottom for them. We were hoping they'd go down more in a crisis, and then we would have grabbed them. Cheesecake Factory is still pretty cheap. Caterpillar, 243, and now it's 212. But a recession can drop them back down to 160. I wouldn't really consider them cheap until they get down around 180. Capital, those guys are pretty cheap. CIM, CIM we still have. NLY we gave up on. CLF, good price. So you just keep going through it, and this is what you do, though. This is what bargain shopping is. We've done all the hard work. We've already picked the stocks that we think have good, solid bases. And so what we're looking for is which one of these guys fits your portfolio and is on sale. Who's going to fit in properly? Who's going to be the right stock to add? But it's easy to see what's a bargain. This is like going down the aisle at the supermarket and say, oh, look at that. That's on sale. That's expensive. I won't buy that. That's expensive. I won't buy that. That's not so bad. That's on sale. Generac's back on sale. We got out of it. Now it's getting cheap again. We'll probably get back in. Honeywell. Oh, what did Honeywell just do? They just sold something to somebody. That's what they did. They sold, Honeywell sold something to somebody. That's my profound statement on the company. Now they sold something I wasn't thinking about, and it was impressive. It was something to do with alt energy. I don't know. Anyway, but they sold something to do with alt energy I wasn't really aware that they were doing, and it was I think it was a good deal. I think it's a nice avenue for them I hadn't thought of. IBM is IBM. We always like them if they're cheap. IEP, look at that. I mean, they don't go down. They are somebody is a huge buyer of them down here, obviously, right? Somebody down here is buying them, but somebody up here is selling them. So they're kind of channeling. International Paper is a good one. That's all you got to do, though. Just go through the list once a month. Whenever you want to buy something, go first to a list and add ones yourself to the same list. But you know, have a list and go through it and say, this is a good stock. This is a stock I want to be investing in. And that's what I mean by, and it makes diversification easier too, because you say, well, look at all these. There's got to be, I mean, they're 50, 100. I don't know how many. There's a lot of these freaking things. There's at least 50. Did I count it at some point? The watch list, 50 stocks. Oh no, we purged, 60 finalists. That's what it was. So we had 60 finalists for our trades. These were all trade of the year contenders for one reason or another. We ended up with Yeti. Whatever happened to Yeti? I haven't paid attention. Oh, that's a shame. They were coming on good. So, you know, don't forget, we picked that stock of the year here with Yeti. It took off really fast, so we're in good shape on it, and it was doing really good, but then it dropped off, and it was holding around 40. Now it pulled back a little bit, but I'm confident. Our goal is like 45, so it's not an issue. But that is the gist of the thing. Is all we're trying to do is just find new stocks to buy that fit with the ones that we already have. That are going to give us some diversity. And especially if you say, okay, what's going to be a hot sector for the next few months? And you say, well, I think that biotech should come back a bit because of whatever. And then you say, okay, well then I need to find a biotech stock. So you start plowing through the list looking for a good biotech that's on sale. That's what you use this thing for. Who's a biotech? Who's cheap? You know, I don't have any manufacturing stock. I don't have a consumer retail. Look through the list, find a consumer retail. Or I dumped all my financials in the crisis. What should I buy? Buy Allstate. That's pretty obvious, right? That's all we have to do to stay on top of things and stay diversified. These are the tools that we use so that we can follow the good investing rules. All right, so that's it for this week. Sorry it's short, but I got to go, and we will certainly do it again next week with a whole full proper session, I imagine. All right, any questions? Let's see if there's any last minute questions. Nope, Dan says the audio is only out for 30 seconds. Hopefully it won't be that way on the recording, and you can find out what valuable things I said during those 30 seconds. But anyway, have a happy holidays, everybody. Thanks for coming. I appreciate it. Take care.